Good morning. My name is Drew Moore, and I've got Brian Basting and Michael Reginelli here to hash out the May USDA WASDE report. So with that being said, Michael, first question, what was the big takeaway today in the report?
Kind of a quiet report. May typically is somewhat of a muted report. Big thing today was demand adjustments. We saw corn carryout drop 95 million for old crop. I think that was basically within market expectations. A lot of private analysts are below that. We've known that the USDA was probably lagging from their demand estimates for some time. They're beginning to catch up with where the privates are. So that was kind of the one thing that jumped out. Bean carryout stayed steady. Only other thing that stood out to me was the world estimate numbers for 21-22. Corn estimate was about 9 million metric tons higher than the average trade guess. So long way to go before we hit that estimate, but it's a pretty healthy jump.
Sure. Brian, how about wheat?
Wheat feeding is a big deal this coming year, Drew. Whether it's domestically here in the U.S., USDA forecasts a 70 million bushel increase in wheat feeding here in the U.S. For this coming crop year compared to the current crop year. And worldwide wheat feeding continues to be robust. We continue to look at China, substituting quite a bit, as much as they can, given their circumstances with high domestic prices of corn in China. Their feeding wheat is forecast to be quite high still in 21-22. Domestically here in the U.S., we got a really nice yield-wise soft red crop coming on according to USDA. Hard red crop is still a little bit challenged with some dryness in part of those areas, but we are forecast to get some rain out there. So I think right now the biggest thing that stands out to me on wheat is the wheat feeding in terms of the substitution for corn coming up the next several months.
Sure, that makes sense. On a global perspective, Brian, shifting our focus maybe to South America, Brazil specifically, we had the CONAB numbers this morning. You just had the USDA release. What do you see there here moving forward?
And that's a great question, Drew, because the market is zeroed in on that Brazilian crop right now. CONAB was a bit conservative, only down to 106.4 compared to the recent estimate there back in April was closer to 109. Now the USDA this morning though was 102. Now this is for the crop, of course, it's growing now. That crop is going to be made over the next 30 days yet as we finish pollination, then we go through grain fill. And that crop still has some vulnerability. The private trade estimates are trending lower, below 100 million now. I've seen a few estimates even approaching 95. So really looking at possibly a lower Brazilian corn crop. The record Brazilian soybean crop, though, is going to compete with U.S. bean exports, 136 million tons for the next 6 months or so.
It's big.
Not a lot of rain or signs of relief, too, for that second Brazilian corn crop, too. So it feels like estimates are trending lower.
Yeah. Michael, 3.5 months left in the marketing year. The old adage comes to mind, high prices cure high prices, right? What do you see from the corn demand spectrum and the margin structure from some of these end users? Is it deteriorating? Is it getting better?
So far, high prices don't seem to be curing high prices. Demand is outstanding. Corn and beans. Margins look good along the curve for not only ethanol on the corn demand side, but bean processing margins really all the way through the strip into new crop look pretty solid. Animal margins for the most part are fairly good. You have livestock prices surging right now, and the export story is playing out and has kind of been told. And if anything, we're continuing to pack corn sales on. The bean export story has been told. So we're not seeing a lot of demand rationing across any of the three big demand sectors in corn or the major two in soybeans. So at this point, it doesn't seem like that's happening. Demand is awfully strong, even with higher prices in both commodities.
Sure. You touched on 21-22 marketing year. Brian, what do you think here moving forward? I mean, is this a one-year type of deal? Or does this tightness persist across the U.S., across the globe, for the next year or two?
A lot of moving pieces, Drew, as we go forward here. These next 6 months are going to be critical. Number one, can the market, as Michael highlighted, we are not slowing down usage. Can the market encourage enough acres here for the 21 crop before the planting window closes here in the U.S.? Obviously looking around that mid-June planting window for corn. Probably the 1st of July, maybe early July with double crop beans. But I think we're really looking at a dynamic situation where old crop is quite tight. Now new crop, Michael highlighted earlier, the market was surprised by the new crop production estimates. The new crop Brazil corn estimate is 118 million tons. You highlighted a moment ago, Drew, high prices cure high prices. When you're talking about 118 million tons in Brazil, and this year maybe below 100, and then next year's soybean estimate in Brazil is 144 from the USDA. So these high prices will stimulate increased production, not only here in the U.S., but also in South America, and then you can extend that into the Black Sea region. So final thought on that is last year at this time, Drew, the USDA came out with a carry-out estimate for corn for this crop year, 2021, 3.3 billion bushels.
Yep.
Of course, we had supply issues with the derecho, we had supply issues with the dry finish of the growing season, and then we had, as Michael highlighted, exceptionally strong export demand this year, and now we're looking at a 1-2 carry-out for corn. Bean carry-out last year was projected at 400, now it's down to bare bones at 120. There's been other years where it's gone the other direction, where we've seen the carry-out go up from these initial numbers. So just always defend your balance sheet as a producer, knowing that things can change, they can change very fast.
Absolutely. Michael, last question here. You talked about in our last segment about an influx of money into the ag space, and you called that at the beginning of Q2.
Right.
You know, as we look at the spec fund longs in the marketplace per the CFTC data, do you think we can scale up to a different level? Do we drop off? Or what are your perceptions on fund length moving forward?
Potentially. I mean, when we talked about it March 30th, I mean, we kind of thought that was going to continue. I think it has. Right now, we're hitting levels that we haven't seen before. So, your question's how do we move forward? And I think it's possible that we continue to see investments until we start seeing longer-term signs of either demand relief or we get more confidence on uptake in supply. Sure. You know, we're coming into a heavy demand season from a driving standpoint. We are concerned. Commodity inflation's on people's mind as you know, as we kind of get out of the COVID lockdown. There's some supply chain issues, kind of up and down from a labor standpoint in the animal sectors and others too, that are kind of on people's minds as well. So, I mean, I think from an inflationary standpoint, you potentially do see funds continue to buy and maintain long positions in the ags as a bit of a hedge. And you know, corn and soy ETFs are 52-week highs. So
Sure.
you know.
Sure. Well, thank you both for your time today, and good luck. Bye-bye.